And I wonder in commercial real estate when this gives way. When's it when high yield or, sort of garbage IG bonds actually have a huge yield, which again means price down?
When the refinancing starts, 2025, at another year or so. I can't speak to commercial real estate on that mortgage issue, Tom, but for residential, for people at home sitting in houses with very low mortgage rates,
how do you feel about
this
them?
market's frozen. They're not going to sell.
Yeah, how do you
and
feel
people
about that?
can't buy with rates at 7 or 8%. You know how I feel about it.
Well, there was a whole article
what did the New York
about
Times? I know.
I
know
loved it.
New York
like,
Times at the end of the article, they called it mortgage envy, didn't they?
Yeah. I was
mortgage
like,
envy.
I know who they're writing about.
I know.
Citing John Farrow.
I'm pleased I was inspiration.
You were inspiration for a New York Times article.
This weekend, citing a Farrow sighting at match outdoors there on their little French tables that they have on 64th Street. He's going, you want what for,
insane
3,000 square feet or whatever. What I did this weekend was simple. I'm starting to learn the map of Germany, that Munich is 355 miles. You go north to Bremen. Is that how you pronounce it? I'm really ignorant on this.
Okay.
No pride here. August 18th, Friday.
Is this about your lost son, Harry?
Werder Bremen plays Bayern Kane. And, I'm learning about Bundesliga. And I called up Counselor Amy and I said, we got to book somebody on Bundesliga. So, we did.
You've made that booking.
If it's like Luton.
Does our next guest know that he's talking about Harry Kane and Bayern Munich?
Our next guest got relegated. His team got relegated in Bundesliga football, and it's the only. That's why Karsten Bresky's with us, global head of macro research at ING. Your Berliner team, Karsten, got relegated as well. Let me cut to the chase before we get to serious ING work. Is this league the same as Premier League? Is Harry Kane going to go in and get 3 goals a game, or does he have his work cut out for him?
No, but he plays for Bayern Munich. But the bad thing is, Tom, he actually lost the very first match already on Saturday. That was the Super Cup against Leipzig. So it was in 0-3. So it was not a good start for Bayern Munich and Harry Kane.
See how we do this? It's just, I'm going to tear up here. Amy is so good to get this. We bring Bundesliga. I can't go forward, Lisa. Bring Karsten in on ING. I can't talk.
I'll volunteer. Yeah.
Karsten, I'm not going to talk about the Bundesliga. Maybe another time. I am curious, though, about what Elsa Linius was talking about with respect to divergence. And we've been talking about that for a while. When will the economic divergences play out and market divergences? Are we seeing market divergences with the economies of the U.S., of Europe, and of China?
Well, of course we do see them because the U.S. is doing much better and everyone fears this soft landing, hard landing, but it hasn't happened so far. With Europe, I think there are a couple of people, including the ECB, still too optimistic because here we have the problem of not only cyclical headwind, but also structural transition. So my best bet currently is that Europe is in for a longer stagnation, like my favorite soccer club. And China, third one, is clearly also in this very long soft patch. So there is global divergence. I think it's the very first time for a long while that we're seeing and witnessing this big divergence.
Have we fully appreciated how much of the weakness that we're seeing in China is bleeding over into the European economic picture?
Not entirely, I think. Plus, I think we have not fully factored in the fact that China no longer plays the same role for Europe as it did in the past, especially for Germany. Because I think in the past, China was almost in a symbiotic relationship with the German economy. So there was big need for made-in-Germany products. But this time around, when you look at the export data, also when you look at the fact that China is able to produce the same products these days as Germany or other European manufacturers are producing, China is no longer playing the same role as it did in the past. At the same time, with this weakening domestic economy in China, Europeans will not sell their exports.
Karsten, what will flows do? What I'm most focused on this weekend was foreign direct investment. And obviously the headlines are in the dearth of foreign direct investment into China. What do you presume will be FDI between Europe and America or Europe and China?
Well, between the U.S. and Europe, it is clearly turning to net positive for the U.S. We have been seeing already a trend of FDIs coming into Europe declining. And at the same time, this Inflation Reduction Act in the U.S. is clearly triggering foreign direct investments from European companies going into the U.S. Well, when you look at U.S. China, also Europe China, I think we will see clearly a reduction in both U.S. and European FDIs going into China, simply due to de-risking and the new geopolitical situation.
So critically here, and with the news flow of the last number of weeks, can you get on board with the IMF's 5-year lassitude, the lethargy, the lack of global trade, just a dampening of the economy out to 2028? Can you get on board with that?
I can definitely get on board with that, because I think this is pretty much the reality. Well, you don't call this the end of globalization, but I think we should call this the end of globalization as we knew it. So global trade is clearly slowing down. We will see more regional trade popping up, but with global trade slowing down, being much more sluggish, it is obvious that the countries that benefited the most in the past from global trade, and we have a couple of Europeans, I'm living in one of those, they will be hit the hardest from this end of globalization as we knew it.
So, Carsten, the German model, what's left of it? How do they change?
Well, there is not a lot left of it, other than, I don't know, currently buying English players to get to the Bundesliga. No, I really think this is, and not everyone has realized it yet in German politics, this business model has come to an end. A business model that was highly depending on export growth, and it was also highly depending on importing low energy. So with this new world, we will see also a restructuring of the German business model. And of course, then you have two narratives. There is one where you think, all right, maybe German manufacturers, German industry can still embrace new technologies, sustainability, renewables, and then can kind of, rise again after a couple of years. The other one would be a global economy that is moving more towards services. And to tell you the truth, the German economy is definitely not strong when it comes to services.
Carsten, thank you, sir. On the next act for Germany and Europe, Carsten Bresky there, the global head of macro research at ING. Germany and that model, Tom, to outsource defense to America, to outsource energy security to Russia, to outsource economic security to China.
Yeah.
It's almost a fail across the board.
I two things there. What I observed from Carsten Bresky, and again, I'm learning a lot about this. I mean, it's just very simple. He said Bayern Kane would not be relegated this year, which I think is, an important piece of information.
Is that a headline this morning?
It's a headline. But the other thing I see here, and I think Lisa and I got to give you a massive victory lap on this. You were the first one I heard, John, who said, what does this say about the 14X year heritage of Angela Merkel? You were the first one I heard talk about that, and I think that's going to be a source of serious academic analysis over the next decade.
I wasn't alone. It was many years ago, but ultimately, too many people got too cozy with the views of the Chancellor in Germany, and there's a lot of blowback, and we're still feeling it today. Sebastian Page at T. Rowe Price coming up next from New York City. Futures higher. Good morning.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
I think the inflation dynamics have maybe shifted slightly in the U.S.
We don't see really any possibility for the Fed to be cutting rates until next year.
I think there's a risk they cut faster than the market thinks.
I think there are lags of monetary policy that will very slowly but surely slow down the economy.
We need to stick to our work that tells us that a recession is likely to unfold.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Getting your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.25%. We've talked a lot about this week, dominated by retail results. Walmart Thursday, Target Wednesday, retail sales tomorrow morning. The next stop, Tom, out of Jackson Hole, Wyoming, and the Federal Reserve annual get-together a week away.
The central banker to the world. I mean, it's just great. I mean, you and I are standing there and we're on the split rail fence and there they come down the line. It will be Lagarde, Powell, maybe Ueda will show up in Bramo. They'll all be there going out to wave to the elk.
In a bear suit.
You got to see it to believe it, folks. We'll bring you full coverage of that. Our team will have team coverage of the wave, as Chairman Powell will point out, as central banker to the world. And what he's going to point out to it, he's going to go somewhere out there is a 150 Japanese yen. Moments ago, we get a 145 on Japanese yen. Weaker yen, a proxy for Asia.
And they'll be talking about that, the yield curve confusion, YCC over at the BOJ. Do you like that, Lisa? Yes. In Europe, they'll be talking about the disappointing economic growth. And in China, I would have to say, real financial turbulence coming to the surface, Lisa, just a little bit more over the weekend.
There's such an interesting tension setting up this week because we've got that weakness in China that also has contagion paired with what everyone's expecting to be the resilient U.S. consumer. The retail sales that are expected to show that people are still out there spending and that they have money to spend, even though they've whittled down their savings rates. So which wins? And this goes to the battle underpinning the yield space, right? Can yields keep rising with that overhang of a potential contagion coming from China, coming from weakness overseas?
I'm going to go to a price analysis, which is at some point you have, the street, and we're as guilty of this. You look at a yield analysis, oops, until price comes down enough where it's like, oh, I'm losing money. How close are we to the oh, I'm losing money. You can quantify that any way you want.
I think a lot of people have lost money in the credit market, Tom.
Like a 3-year bond bear market, is that what we're talking about? And
that I don't know about, but I think we have to highlight some of the moves we've seen so far over the last few weeks. One is crude, massive move off the June low of more than 20%. That's worth highlighting. The other is in the bond market. The long end on a 10-year yields up by 30 basis points in 3 weeks. And Lisa, you ask 5 different people what is behind that bond market move, and they will give you 5 different reasons what is behind that bond market move.
With some people just dismissing it as a technical sort of blip that doesn't make a lot of sense, right? And then you have other people saying, no, this is the key risk for the Federal Reserve, that they stay on hold, they are complacent with some sort of soft landing, and inflation restarts to accelerate. We've heard that from Jim Bianco. We've heard that from a whole host of other people as well, including Neil Dutta. And at what point do we see the data to edify that kind of idea? Probably when it's too late for the Fed to respond.
Let's run through the scores this morning, this Monday morning. Equity futures just about positive by 0.25% on the S&P 500. There's that move above 4% on a 10-year yield. We stay there, Lisa. Unchanged on the session at the moment. Your 10-year yield, 4.15 on a 10-year.
Today's quiet ahead of a big week for retail sales in particular. Today, James Bullard is leaving his role as St. Louis Fed president. He's becoming the dean of Purdue University's business school. I think it's interesting to note his departure because he's been such a loud and sometimes contrarian voice and has been hawkish of late. Who are the hawks remaining on the Federal Reserve? 5 p.m., Treasury Secretary Janet Yellen is deployed to Las Vegas to talk about the Inflation Reduction Act, which is going to be a big sort of drumbeat this week from the Biden administration. He heads to Milwaukee tomorrow. And at 10 p.m., this really is the key point to me. China is releasing a slew of economic data for the month of July. Industrial production, retail sales, jobless claim or jobless data. How much do we see this ongoing weakening, and how does that play out through the markets? Tom talks a lot about the currency mechanism. You do see the renminbi at the weakest versus the dollar going back to November. When does it start to have a more contagion effect?
Well, we're breaking through. That's the first thing I looked at this morning was dollar yuan, and the fact is they're moving. I mean, there's just no other way to put it. To Bullard, you know, one of the great things this weekend was the giant Miguel Cabrera of the Detroit Tigers was at Fenway. You know, it's the end of the season, last time there, and 35,000 people stand up and applaud for like 10 minutes. I mean, his career. Do you wonder? I mean, Bullard. You know, the only reason you go to see Bullard is to go to the Cardinals with him in the 4 seats that the St. Louis Fed has. Is he going to be there tonight at Cardinals A's, and they're going to stand up for 10 minutes and?
How many people in that stadium do you reckon know
who he is?
Who he is.
I love busting Jim Bullard's chops about this. Tom, don't say that. People think we actually have box seats.
Sebastian Page joins us now, Head of Global Multi-Asset and CIO at T. Rowe Price. Sebastian, you can be one of the 5 this morning. What's behind that bond market move?
Higher inflation expectations. Look, we're all seeing inflation coming down. But when I look at my 1-year break-evens this morning on my Bloomberg, I see 1.56%. To me, that is too low. If I think of the risk to inflation, it's not to the downside, it's to the upside. And Jonathan, you nailed the reason. It's the commodities, oil prices being up quietly 20%. You need energy to produce goods and services. And I think sometimes we underestimate the impact on even core inflation of higher energy prices. So I'm not saying inflation's coming back to the levels we've seen, you know, a year ago, a year and a half ago. But to me, I look at this and the risk is to the upside, and that's what the bond market, even in the long end, is starting to smell.
Sebastian, and for radio, this is my most important chart right now. It's a Bloomberg total return chart. This is the all-in, soup to nuts chart as well. And the bottom line here is we're about ready to break down to new price weakness off the carnage of 2 or 3 years ago. And I just don't know what to say here about price down. If we get the bond market to break down to lower prices, what does that do to equities?
You know, it's always a risk to equities because you're revaluing, and year-to-date equities have rallied on the price-earnings ratio on the valuation, and that is sensitive to rates, and earnings are kind of soft, down 7% year over year. So it is a risk to equities, Tom. But one thing I want to say is this is not the time to panic about duration. If anything, now you have a better entry point. In our fixed income portfolios, we have added duration this year. It is a quote unquote, and I use quotation marks, hedge against a real growth shock. We know that the most anticipated recession in history is becoming the most delayed recession in history, but there's pressure building in the system. So here's what we're doing in our fixed income portfolios. We're not panicking about duration right now. I think we have duration, and we're pairing it with credit. I call this the magic barbell, but I'm getting 9% total yield out of high yield. So I like my fixed income factors to be diversified, and now you get paid. You get paid for the protection of treasuries if you get a growth shock. It won't protect you for an inflation shock, which is kind of, we're not talking about an inflation shock, but inflation pressures, which is kind of what you're seeing now. But I think you have to step back and look at what's the greater risk right now is, sell-off in stocks.
Okay, hold on a second. Let me try to make sure that I understand this. You're saying that the risk with inflation is an upside surprise, that it could reaccelerate, and yet you're leaning into duration because it's not an inflation shock. It's just an inflation grind higher. What is the difference?
So we're using duration as a hedge to a growth shock. We're not going fully overweight duration. To me, the risk to inflation is 3-6 months, it starts peaking back up. But at the end of the day, if you take a 6 to 18-month horizon, so Lisa, it's a difference in horizon here, you do want some hedges in your portfolio. And where do you get those hedges? Right now, you get them a little cheaper than you have in the past. So it's nuanced, right? It's just diversifying the different risk factors.
And one thing that you talked about was the commodities pressure to really fuel some of the reinflation. And this comes as we take a look at China and the potential threats there, the risks to growth. If, let's say, there is a reversal in oil prices and that comes with a lot of weakness, how do you rearrange at a time where you're preferring high-yield bonds over equities, where you're preferring sort of some barbell approach to really being a more conservative kind of asset allocator right now?
Yeah, you look at the spread for high yield, it's not particularly attractive, although if you adjust it for forecasted default risks, it's not bad. But I'm an asset allocator. I really care about the total yield. And Lisa, the comparison with the earnings yield is really advantageous, 80th, 90th percentile in favor of high yield bonds. I'm getting 9% out of high yield bonds globally, and the earnings yield is down to, say, 5% on stocks. That spread right now is really advantageous. We're not forecasting a really hard landing wave of defaults, even if things slow down in China, which they are. So on a relative basis, look, we always invested in stocks, but we're close to neutral right now, slightly underweight.
Right.
If we're going to add to the portfolio on the risk side, might as well do it with high yield.
Sebastian, very quickly, your acclaimed book, which is, folks, I can't say enough about this effort by Sebastian Page, a really sophisticated effort. Do I want to be diversified or do I want to be more acutely focused right now?
Look, I think diversification remains critically important when you're going through a regime shift, Tom, which is what we're going through. You've talked about this on the show. Gravity is back in financial markets. We have a ton of cash in the sidelines, so you don't want to go all the way to cash, right, and just miss the upside of stocks in the long run. I don't think you want to go all the way to stocks right now. And there are other opportunities. Look, Tom, let's just think about valuations. Okay, the tech sector is trading at a price-earnings ratio of 30. So let's say you missed the rally. Do you want to chase that momentum or maybe wait to buy the dip? You actually have a third option, which speaks to diversification, which is to get in parts of the markets that have really not participated. Quality small caps, price-earnings ratio of 13. That's hard recession level. Emerging market stocks, price-earnings ratio at 11. We mentioned high-yield bonds, yields at 9%. So the energy sector trading at 12 PE ratio. So there are ways to get in the market where you're not just chasing the momentum. And I call this the third option. Either you chase the momentum, wait for the dip, or take a diversified approach to your question, Tom, and get in parts of the market that haven't participated. Energy, EM, very high yield, higher yield in the high yield bond space. So there are opportunities to get in, Tom, and diversify.
Sebastian, always enjoy your insights, sir. Good friend of this programme. Sebastian Page there of T. Rowe Price. If you're just tuning into this programme, welcome. Welcome to this programme and good morning to you. In the equity market, we're positive here by 0.2%. I can't think of two bigger stories in financial markets right now. The commodity market, one, the bond market, two. Sebastian Page connecting both.